All right. I think we're live.
All right. We're in the
All
studio.
right. Yeah. We're jumping on now. So appreciate everyone coming on. We'll give it a couple minutes. We definitely have, we're going to try some new stuff out today. So appreciate everyone jumping on. And so, last week we had what, 20, and let's see, Wednesday was, we had JP on speaking about interest rates. So, what was your feedback from people last Wednesday at our Old Capital Speaker Series?
Yeah, I thought the content was, top notch. Everything that you would want to know about banking, interest rates, what's going on in multifamily, just the latest info. I think he did a really good job of just going over everything. Even in, I learned a lot about, those bank deposits. What was that chart that he had where it's like .com, GFC, and then SVB? It was like the borrowing window.
Yeah. So, I didn't prepare you for this, but I guess we'll just jump right into it. So, let's see. All right, here we go. Let's see. We're learning as we go here. Let's try this. All right, so can you see the slide deck?
Yeah, I can see it.
So here's some of the stuff that we went over with Pittsford last week. So this is how he started it. Like, this is fine. Everything's
Nothing to see here.
And so for his actual thing, this newsletter this past week, he put Jay Powell in the seat right there, saying this is fine. So, so some of the forecasts he has, I think this has even changed a little bit more now, but pretty much no change for the May, and then so hit the pause button in May, and then come down from there in June. And this was the window that he was talking about in terms of discount window borrowing that he's seeing out there. So, I mean, yeah, huge number. I asked for an update, and it was pretty much, it's a big number. So 125 billion or so that people came to the window for. So banks who needed money, they're asking the Fed to sort of backstop themselves right there. Any other charts that you thought were interesting? We had seen the inverted yield curve. We saw that piece last time.
Yeah, I've seen his charts on, the average cut after they start pausing. I always think those are good to go over. Kind of gives you an idea, right, of if you see first pause, he said they're really not going to start hiking again because they don't have a history of hiking after the first pause. Right. So then after the first pause, that within about, 5 to, what is the longest one, 14 months?
Yeah, 5 to 14 months. Yeah, so on average,
they go down average, pretty sharp.
Average about 9 months, and then from there, this was a lot steeper on the hike. So I like try to remember back, like I never tracked federal funds like my entire career until now. So just like, I guess it was hiking the whole time back here, but all these other times, but I wasn't tracking it. So,
I learned a lot about the Fed and interest rates and all that stuff during grad school. And so now it's kind of interesting to see everybody's talking about it all the time now on the news and on social media and stuff. So it's kind of cool.
All right. I think I'm off now. All right. So not only we got a lot of questions in from attendees, and so we wrote down a couple of them, and we'll jump in and go through some of them now. What you want to kick it off with the first one?
Yeah, sure. Question number 1 is agency loan for new investors. So someone coming right into the business doesn't have any experience, maybe has some single family homes. What's their good agency loan for them?
All right, I'm going to try this out. So, all right, so let's see if it works. All right.
Fancy.
Yeah, we're getting fancy here. So, majority of agency loans out there you actually can't get unless you have some sort of experience. So the main thing that you want to do is maybe partner with someone who has experience out there in terms of multifamily experience, and then once you sort of get the card, then that allows you to buy your own deal potentially later. So, like for example, let's say I have experience and James Wilson does not have experience, then James can sign on my deal with me for the first one, and then now he's got the card and he can go out and sign on a new loan. Um, Fannie Mae and Freddie Mac SPL, they're both a little bit. Um, I guess we always think about it as, if there's enough leverage or the leverage is too high or the debt service is, barely 125, that that's all you're going to be able to do. But if they do lower leverage, you can also potentially get an agency loan, maybe not at 75%, but maybe at 60 or 55%. And then you can do your first loan that way with good third party property management. So what have you seen on this?
Yeah, I see the same thing, and I tell people the same thing. Basically, if you want to do a bigger deal right off the start, you got to find somebody that's already done it. So figure out a way to add value to somebody experienced. Or if you want to do it yourself, go for that Freddie SBL small balance loan. Do a loan between 7.5 million?
7.5. Yep.
Somewhere in that space. So probably a smaller deal, kind of like the deal we just looked at yesterday. Would be a perfect Freddie SBL for a new investor.
Give people an idea of that deal. What we saw out there.
28 unit townhome deal out in Rowlett. Had a lot of 3 bedrooms, 2 bedrooms, had car garages, and it was like in a quiet neighborhood right on a lake.
Yeah.
So it's the ideal first investment for someone trying to get into multifamily, in my opinion.
Yeah, it wasn't too big.
Construction. He did some roof work. Definitely some value add, fixing up the interiors, and rents were below market. So it was a good one.
All right. Anything else on agency loans out there, or should we keep cranking?
Let's move on to the next one.
Okay.
How are cap rates related in interest rates?
Look at that banner. Do you see that?
Boom. Leveling up on this one.
What's funny is like a lot of people were thinking that they wouldn't be. People thought, yeah, interest rates are going to go up. And I think if interest rates went up, let's say 50 basis points, it probably would have been fine. Cap rates probably wouldn't have moved. But when your short-term rate goes from 0 to 4.5 on SOFR, it just impacts everything. And so cap rates have moved at least 50 basis points, if not 75 in most markets. And then, I think people are thinking that it's going to keep moving, probably 25 to 50 basis points, even more as more and more people sit. So I think the longer people sit and deals don't happen, then cap rates are going to just keep going up. What are you thinking?
Yeah, I think if the cap rates, obviously the sellers want to hold on to what the cap rates have been in the past and kind of want to hold their current value, but the longer they hold and the less activity or the less people trying to buy them, I think they are going to move, because you don't want to come in and have to raise 50% of the loan, or the 50% of the equity, because
Right.
your loan proceeds are still low because the price is still high. So I feel like the less people moving in with those bigger raises or bigger down payments, the more those cap rates will expand.
Yeah, I'll pull up this. Let's see if I can do it. All right. So this was, can you see that okay on the cap rates? So
Yeah.
this was from Newmark, and it pretty much showed by market sort of what the expansion's been. I think this is second quarter. Let me see. Yeah, so this is between third and fourth quarter of last year. So we're seeing cap rate expansion of anywhere from 50 basis points to like 87 basis points or something like that. So pretty much everything's in the fives now, just sort of where rates are. And then some of these smaller markets, they're getting up to 6. So
Motor City.
Motor City, Detroit. Yeah.
Get some deals out there.
Yeah, for sure. So, all right, let's go to what's the next one out there.
This is a long one. See if you can type it up.
All right.
Are more 50 units or less being traded? And if so, what is the story around their cap rates by A, B, C versus larger unit sizes? Any noticeable differences?
All right. Let me try to add that real quick. All right, check this out. Let's see. All right. Oops, you gotta hide this one. All right, there we go.
The ticker.
Yeah, that's a little tricky. Hold on. Let me just switch back to just regular.
I think general question is, what's going on with 50 units and below? What's going on with 50 units up? All different asset classes, or not asset classes, but Class A, Class B, Class C. What are the cap rates?
Here we go. There we go. All right. Sorry, the ticker was going too crazy.
Too distracting.
I think the smaller deals. I mean, like we've seen deals in the last couple weeks, a lot smaller deals come out, and so to me, those cap rates. I'm trying to think if they're still priced around the same. I would say the larger deals are probably less volatile. We're probably seeing more volatility in the probably B minus C space more so than the A and B space. So I'm trying to think if a lot of I think there's probably a little bit more liquidity in the smaller deals right now, just because the equity raise isn't as high. And so, individuals, 1031 guys, they're able to get those deals done right now.
Yeah, I think I heard on a podcast or somewhere about Class A deals that sometimes during like a downturn, that Class A cap rates kind of compress a little bit because a lot of people like flight to quality. A lot of people go those nicer assets. A lot of money flows to them because they feel like it's a safer bet.
Safer bet, yeah, for sure.
B plus stuff that a lot of people compete for here in Dallas, and then B minus C, those could gap out quite a bit depending on material condition. We've gone to some C class assets that have been really well maintained compared to some others. So I feel like how much capex and repairs you need is also an indicator.
Yeah, I don't think anyone is loving doing a huge value add deal right now. Just with you're just not sure what rent bumps you're going to get.
Yeah.
So people are a little bit more hesitant to do the big, 10, 15, 20,000 per unit rehabs right now.
Yeah, and if we're in a Patagonia recession where it's just the Class A tenants taking a little haircut on their net worth or assets.
Right.
But if it starts becoming, a deeper recession where blue collar folks start losing their jobs, that's going to impact the rent you're going to be able to charge or raise on a value add deal.
Right. Yeah. So, I think we're seeing more. I'm trying to think. There's definitely not as many A deals on the market right now. And so it's harder to figure out sort of cap rate. More B and C stuff and smaller deals are out right now here in DFW.
Yeah, just recently there's been more B and C stuff coming on the market, but I think from maybe December or even January to February, there just wasn't a whole lot kicking around. But yeah, the last few weeks, last couple months, starting to see more and more of those smaller BC deals come out on the market for sure.
Everyone's waiting for the flood. The flood hasn't happened yet. So
everyone's waiting for the distress. But do people come back in the market when the distress happens? It's a lot easier to say when times are good, right? That you're going to buy distressed assets.
Yeah, I mean, we'll have to see. Have to see how much distress there is. I mean, if uh, if rates get cut, cap costs come down, there might not be as much distress as people had thought, and then you're gonna wish you
Yeah.
bought everything. Yeah,
Yeah, it could be a narrow window of opportunity, right?
yeah, for sure.
So, so move on to the next question. How to adjust to the current financing constraints?
Yeah, I mean, I think like I talked, there's been a lot of, you know, people are a little bit scared on the regional local bank side. And so I would say that's probably the toughest part of the market right now in terms of where you can go and get debt. But I mean, the pricing on their stuff is sort of around prime. I think prime's 8% now. So, you're going to be 7.5 to 8.5% on any recourse bank loan from a local regional bank. So, majority of the stuff we're seeing is really Fannie and Freddie, and their constraint is 90% occupancy for 90 days and a 125 cover. So that's pretty much what I would use for underwriting. I guess the question really is, at what leverage point can you buy the deal, right? Because most of those deals are about 60% levered. So 60% levered at 6% interest rate, how much stuff can you buy? And if it works at that number, and you can raise the equity, then let's go. I mean, what else? What else are you seeing on the financing side?
Uh, Financing constraints. So the only financing constraints that I see other than just not being able to get the leverage is, trying to raise that extra equity with the low the agency loans are there. They're always going to be there. That's the great thing about multifamily, right? Is that they'll always be available through any banking crisis. Um, but just that leverage is not high enough for the price points that people are wanting to sell for. So I guess go back to the first question where if things continue the way they are, that leverage will start creeping up and those financing constraints will start to alleviate a little bit, in my opinion. But yeah, the
Uh,
banks are tough to get financing right now because they're a little skittish.
all right, so we'll throw this. This is a add on to the last question. So we give you 55% or 60% leverage, and then now you've got to go out and raise the equity. I
Big
mean,
raise, yeah.
yeah, I mean, this past weekend you were out with some investors. What's their feel on equity right now?
Um, Equity's hard to come by. I think a lot of equities tied up into deals, and deals were trading at such a high velocity last year and the year before that you put 100,000 in a deal, and 18 months later you're spitting out 200,000. Then you're going into two more deals, and that's snowballing like crazy. But now it's been gridlock for a year. Everybody's money's tied up in those deals, so you're not seeing people either have the money or have the appetite because they haven't been getting any distributions or their money's not coming back. So you're going to have to go, I think, get fresh equity, new LPs that maybe are not accustomed to the multifamily returns in the last 3 to 5 years, let's say. But yeah, I know you had a Shark Tank last week too, right? With LP.
Yeah, yeah. Yeah. I should try to pull my. We're doing this on the fly.
Yeah, what was the take on the that room? Nice.
um, yeah, no. So about a month ago, we went through like 3 deals, and people were sort of 50-50. This was in February,
Yeah.
and people were sort of 50-50 on whether or not they were going to be in the deal, and just normal B deals in DFW. And then after all sort of these banking crises, and nobody knows what the next shoe to drop is. um, we had one last Friday, and it was almost just like you had to like pull teeth. It was like pulling teeth to try to get anyone to say yes. And this is just a poll. Like, this was just like we went through the deal in like 5 or 10 minutes. we put up a poll, hey, would you invest in this deal? And pretty much everybody was like, no, I'm not investing in that deal. Like it was pretty difficult.
Someone
So the
asked for a
sentiment,
maybe. Someone asked for a maybe, right?
yeah, someone asked for a maybe, and I'm like, there's no maybe in real life. So it's either you're in the deal or out of the deal. So I would say it's pretty difficult to raise equity. You know, I think it was probably like 2 years ago or something. I was talking with Jeremy Roll, and he was like, once the downturn hits, the number one challenge, this is the hardest thing, is to raise equity. Like everybody thinks like when the market's on fire, everyone's thinking, okay, once prices start dropping, then yeah, that's the time to buy. That's the time to jump in. That's the time to buy all these deals up. What they forget is like nobody wants to invest with you because it's hard. Like it's hard to know if this is the bottom.
Yeah.
Right.
I
So
mean,
the sentiment isn't good. Everything's negative. Everyone's like, man, I should have bought everything in 9, 10, 11. It's like, well, financing was hard. Equity
yeah.
was hard.
Nobody
And
was lending. Nobody was
yeah,
investing.
yeah, you probably had to slog it out for 3 or 4 years before like the basis was good, right? That you're buying at. And so I think that's what you have to remember sometimes is that it's difficult to raise equity, and the more cash you have ready to go, more liquidity, then the better off you're going to be, I think, right now. So
Yeah, you don't want to put up $100,000, $200,000 and then not get the deal done and lose some earnest money or some third party money for inspections and whatnot. So it's definitely risky.
yeah, I should just keep that Shark Tank always ready, because one thing to think about also is um, the same way that in Shark Tank, when there's 4 guys or 5 guys bidding, they're sort of competing with each other a little bit to put in the
Mhm.
equity. But right now, like, there's no one bidding against each other, right? Like, you're having to go. I don't think you put it out officially. Your video on Capital Raiser trying to track down an LP right now. We'll put that in the comments, maybe.
Yeah,
But
hit a
yeah,
little too close to home.
yeah, a little too close to home. So, all right, let's keep going. What's the next one?
Question 5: how to handle a bridge loan in the current market? And I'm guessing how to manage a bridge loan that you have or get a bridge loan. What do you think?
Yeah. I would say that's let's take the side of they have a bridge loan right now on their existing deal. So what would you? I'll let you go first this time. What would you say?
I'd say first thing is to get it sized up to see where the proceeds lie, like to see where what your agency options are. See if your loan amount is equal to the existing loan amount or higher. If it's higher, in that case, try to do like a shorter 5 or 7 year agency loan. That way you can get like a 3-year, 5-year yield maintenance if you buy down some of those years to get a shorter prepay. But if it's below the loan amount that you have out, you got to figure out a plan, I think, immediately on how you're going to get around that situation, whether that's try to refinance to free up some escrows. I think we've seen people do that before or recently. Just they've refinanced floating to floating just to reset some of the caps and some of the escrows that are needed. And then also I've seen what else was there? I think
So you're thinking, all right, so get it sized up,
yeah,
see what agency can do on a shorter term fixed rate or even a floater if
yeah.
you're not going to be in the deal that long. And then what's your recommendation if they're short?
There's pref equity or rescue capital options that you could use, but they're kind of expensive, right? 15, they're wanting about 14, 15, 16%.
Yeah.
But I think it just depends on how much. Like if there's a small gap, maybe a loan from the general partnership into the deal. Somebody that's not going to come in and try to take over a deal or, um, you know, or a capital call. Um, but you got to lay out those steps, right? You can't just send one email and you just got to kind of what you said. I think one time was you got to resell the deal, basically why you got to believe in the deal and why you want to keep going and try to raise money that way.
Yeah, I think like Neil Bawa had a presentation at the conference we were at, and it was pretty much like 40 to 50% of these capital calls are going to fail because nobody wants to throw more money at the same deal. They'd rather, I think, put money in a new deal at a new basis. Now that we've seen prices come down, like, why am I putting more money in this deal? So I think in order for people to actually do it, they're going to have to get some sort of preferred return or get sort of be after the senior loan to some extent. So you've got the senior loan, and then you've got your pref, and then you've got your common equity. And I think that's going to get people more comfortable doing those capital calls just to be a little bit more ahead of other people in the stack. So
yeah, and figure out if there's a way you can decrease expenses somehow, if there's some sort of cuts you can make, or water improvement plan, utility reduction plan, bill back, maybe some additional parking. I mean, you'd be surprised. You talk a lot about all these additional revenue streams, but every property you go to doesn't always implement all of those things. I think one property we went to, they had storage units, and I don't even think they were charging for the storage units.
yeah,
There's
I was
stuff
just
like that you could, really try to look around your property and see where you can get some NOI, because I think every bit of NOI boost helps to get more loan proceeds.
I think we'll do a soft plug for our next speaker series. We're going to be interviewing some property and or property management companies out there, and so we're going to have 3 of the best in Dallas here, April 26th. So go on to I think we'll put it in the link, but Old Capital Podcast should have a link to.
You got the link on the live stream.
I can pull it up. Yeah, we'll put it up there. All right. Well, I'm pulling that up. Maybe hit the next question.
All right. How to underwrite for rent expense growth in light of potential recession? Yeah, I think this is a good question. We were at the Best Ever conference last month, and somebody, I think it might have been Jeremy, was making a pretty good plug for, a lot of people were bullish on their different market that they're either raising money in or doing deals in. And that's one thing I've learned is you gotta see who's selling what and what they're trying to pitch, right? And so I thought he had a pretty good take on saying, Ken McElroy had predicted 0% rent growth in 2023 and 7% expense growth. So, I mean, if he's a pretty big player in multifamily, if he's underwriting that, I mean, what should we be underwriting here in Dallas? I think you're on mute.
Yeah. So, yes, on the expense growth, I mean, I think everyone's assuming probably at least 25% on insurance, taxes, probably another 15 to 20%, payrolls up. I'm trying to, what's going down on the expense side? Anything?
I can't.
Nothing.
Can't
think of anything.
Can't think of anything off the top of my head.
Yeah, I mean, one of the things that the on the expense side that we've seen is management companies like Velo Residential that we're gonna have at our speaker series. They've done a good job of sort of implementing technology to sort of offset some of the cost of the payroll at these properties. So I would say that's one of the things. But yeah, it's going to be harder, I think, on the rent growth side to keep pushing organically. It's going to be really, you're going to have to do something to the unit. And what I've seen is a lot of people are starting to trade sort of that occupancy for rent growth. So, keeping it at 95% occupied and not pushing rents as hard just because they don't want to deal with the turnover and spending 10, 15,000 a unit to turn these units over. So,
Yeah, you might see some of the value add component not being met. Less
yeah.
capex.
All right. Let's hit the next one.
Today's financing terms: LTV for agency debt, cost cutting when taxes, insurance keep going up. Cut the capex. Although I don't know if that's always the best idea, because if you let your property deteriorate, it's going to compound some issues, I think. But as far as financing terms, LTV, we kind of covered agencies still pretty low, between 50 and 60%, depending on deal size. Banks can get up to maybe 70. Bridge loans are still, 70, 75%, plus capex. So I think, yeah. What do you got for cost cutting ideas for taxes, insurance?
Yeah, I mean, if you can do it on the payroll side, I mean, really your rents have got to keep up with the market to some extent, or keep up with some of these expense growth items. They keep your NOI moving. Yeah, taxes and insurance are going to keep going up. I'm trying to think on the repairs and maintenance. I mean, if you can minimize your turnover, I mean, that's probably the biggest thing out there. I think that's one of the hidden costs of when you're buying these properties is some of these units are sitting for like 60 days, 90 days, 120 days while they're getting turned. And so keeping the property full, keeping the economic occupancy high on some of these properties is probably what I'd be focused on right now.
Yeah, tenant retention, tenant satisfaction with their living there. Yeah, just keeping turnover low and keeping occupancy high is probably the best strategy. So yeah, definitely come out to the Old Capital Speaker Series next month.
Yeah, we're gonna mix it up. I'm gonna try to break people up into like groups and then sort of
format.
New format. Yeah, so we're gonna put people into groups whether they like it or not, and just we're gonna try to make it a little bit more interactive. So try to get some ideas from the crowdsource some ideas, because it's not easy right now. So
no, it's not. What do lenders plan to do for bridge loans if the property is not qualifying for a refi?
There we go.
So I think we kind of touched on that one a little bit. Some of the strategies that you can use trying to get NOI up, and then potential rescue funds that are coming out that could help get that extra loan proceed for the refi.
Yeah, I think that's sort of from the general partnership side. You don't want to have to go ask the lender for anything, right? But the lender might be in a position where they get the keys from the property in the mail, and they give up on the deal. So, if that happens, then it's definitely going to be, the lender is going to have to decide, all right, do I extend this guy? Do I have him pay down the loan a little bit? Like, it's going to be a conversation where, some of these bridge lenders, they have their own portfolios already of multifamily, and they can just come in and take your deal and move on. And they're not going to think twice about it. Other lenders, this is not their primary gig. Their job is to lend money, not operate apartments. So they'll probably be a little bit more forgiving and give you a little bit more time, but they're going to ask for something, right? If they're going to give you the extension, they're going to ask for, all right, can you get me to 6 or 7 debt yield? I know we said it was going to be a 9 debt yield, but can you get me to a 6 or 7, and then give you an extra 12 months to figure this deal out?
Pretend and extend.
Yeah, extend. Yeah, kick the can.
Kick the can down the road. But yeah, something you should probably talk about with your lender up front as soon as possible, and then they'll probably want to see a business plan as well to see how you're going to get. You can't just say, "Hey, I need more time," right?
Yeah, I mean, most of these loan agreements have specific debt yield or debt service coverage hurdles that you have to hit to qualify for the extension. So if you don't qualify, then you've got to go back to them and get that in writing that, hey, we'll actually extend you, but you pay down the loan by a little bit, right? So you might pay it down by $1 million, whereas the Fannie loan is $5 million away, right? So maybe that's sort of a band-aid. It's not a solution, but it's a band-aid for the next year, and then you can sort of kick the can for another year. So.
All right. What is the best blend for a capital stack?
I'll let you start.
The ideal blend for a capital stack. So if I were to structure my own deal or invest a deal that I'd want to invest in, I would say 70% loan, 10-year term, agency, and I would have to look at maybe the yield maintenance or the prepay on it, but it could be floating depending on what the cap prices are. So I just have to work some numbers there. But I think 70% LTV, agency, long term, maybe even 7-year. That's kind of my ideal criteria after seeing what I've seen over the last couple of years in the space. I think that's a safe structure, and it also gives you enough leverage to make a decent return. And then obviously being well capitalized so that you can overcome any challenges during that time. That's what I think is a good capital stack.
I was going to show you. I saw this. I don't know if I'll. All right, here we go. Let me see if I can do it. I'm always afraid to share my screen. But let's try this. And yeah, we're not promoting any general partner or anything like that. But let's see. Hopefully,
If you're trying to hit a home run, you go 80.
Hopefully,
if you're trying to hit a home run, go 80% bridge, capex, and then 15% pref, and then just put a little LP equity on top.
Yeah. So this is all right. So I'll have a disclaimer. We don't endorse any GP or anything, so we'll just start there. But I thought this post was good. Can you see this?
Yeah.
All right. So this was a post from we don't even need to talk about the name, but so this was a post: long-term fixed financing coming out of the recession. They just utilized long-term fixed financing. So now they bought. This was their stats. So 5% interest rate, 60% LTV, weighted average debt terms, and they have 10 assets in the fund. So
yeah, I mean, that's a great safe core play for real estate.
So
the only reason you go heavier on leverage, right, is because you want to go bigger or make a bigger return.
Yeah, so I mean, I think it's I think they probably have the ability to raise more equity, and so they're putting 40% down on these deals, and that's cushioning them from the 15 to 20% decrease in values that we've seen. They still have some equity, 20% of the equity stack still there, and they're not buying interest rate caps. They're not doing any of that, so they're going to accept the lower return, right? So they're going to still have, but these guys are similar to the banks. The banks bought all these treasuries and they were sort of hold to maturity. That's what a lot of people are going to do as well in terms of their financing. So I think you said 10-year term, fixed or float, but then also probably do like a 7-year yield maintenance. So let me just pull up a sheet. I think it will be helpful for people to see because we were looking at a deal yesterday, and we're trying to figure out, all right, what's the different options out there. And I think a lot of people don't necessarily understand the different options. So let me pull it up, and I think it will be helpful for people. Let's see. All right, so let's see if I can share the screen here. All right, can you see that?
Yes.
Okay, so so this is a deal that we're looking at refinancing, and here's sort of the different options, right? So you have a 10-year loan. That's what you were talking about, 10-year loan, right? Loan
Yes.
rate's about 5.4, spread is about 1.9, and the current loan is about 18.4 in terms of the payoff, right? So this deal, you're gonna have some cash out back to the borrower, right? But then some of these deals you've already owned the deal for 2 or 3 years, so maybe you don't want to own the deal for another 10 years, so maybe you go to a 7-year. So that initial 10-year deal had 9.5 years of yield maintenance, right? So that's what a lot of people are concerned about. So maybe you go to a 7-year deal. So the 7-year deal, the spread is higher. So you're at 562 all in. And so what people have to remember is that your interest rate's higher, your loan amount's higher, right? Because you're hitting a 125 debt service coverage, and then you still have 6.5 years of yield maintenance. And then maybe, all right, I've already been in the deal for 3 years. I just want a 5-year term. So you do a 5 year. So this is probably the most popular, these two on the bottom right now. 5-year term, 216 spread, and you're getting a 125. So you have a little bit of cash out, but then your prepay is only 4.5 years. And then if you want to do a 5-year with only 3 years, that additional spread right there, 250. So that's what, 30 basis points, 40 basis points, a little bit higher in spread to get the shorter yield maintenance. So you have to like sort of look at the combination of what the interest rate's going to be, what the loan amount's going to be, and sort of figure it out from there. Most people, if your current loan's 18.4 and you only get a loan of 18.6, you might have to bring some cash to the table, right?
Yeah, do a cash in refi.
Cash in refi, or you could just go a little bit higher and just do a 5.5, and then you bring no money to the table, right? So I think just depending on the structure of the deal, you have to figure out what works the best for you. So I think this gives you an idea of like, all right, 190 spread, 2% spread, 250 spread. Those are all on top of the treasury, right? So most people don't necessarily care about the spread as much. They're more concerned about their all-in rate of what's out there. And so I think, that's what we're constantly looking at. But, you have to be in position, right? So let me see if I can pull this up. I mean, on, where is it? Let me see if I can, like a lot of people keep asking me, should I lock the rate right now? And you're seeing 10-year back up, 10-year treasury is moving on us. So year to date, let's pull year to date. I mean, it started at 390 or so. And then, we locked. People were like, oh, it's 340. It's going to keep going down. And they missed it, right?
Mm-hmm. Yeah, now it's back to 3.5.
Yeah, I mean, right here, it seems like this is the resistance line on the chart. Like 3.4 seems like that's the resistance line, and then this is sort of the top end. So 4%, 3.5, and 4 are sort of like the range that we're seeing a lot of the 10-year treasury bounce around in. And so, but you want to be in position so that you get the benefit of a 3.5% 10-year treasury right now. So a lot of people are just sort of getting in position, doing the appraisal, doing engineering, environmental, getting all your ducks in a row with Fannie and Freddie right now. So,
so what are people saying when they say it's going to go back down? What is their reasoning?
Well, it's hard, right? It's the same reasoning that you're thinking when prices are going down. You're like, Well, it already dropped 20%. Like it's going to drop another 20%, right? So because all the news
Recency
is
bias.
bad. Yeah, I mean it's like all news is or our bad news is good news, right? So a bank fails, that's good news because 10-year treasury goes down, right? So you're just sort of waiting on some of that stuff to happen. So, but yeah, I think a 10-year fixed on a new deal, 7 years yield maintenance. That's probably my preferred method if you can raise the equity, right? Because that 10-7 is going to cost you a little bit more in interest rate, but it's going to give you a little bit more flexibility on the backside. So, all right, let's hit the next one.
What is the trending LTV percentage on apartment loans?
All right, I think we've hit that one pretty much, but 60%,
Yeah.
60% is the good number.
50, 60% agency, 70%, 75%
Bridge,
bank and bridge.
yeah, at higher, yeah, 7.5 to 8%. So,
Bank may be a little bit lower now with the banking crisis.
yeah. I think they're probably closer to 75 or max 75, but probably closer down to 65. Let's pull up. I'll pull up the sheet here. Let's see if I can do it. All right. All right. Can you see that? Okay.
Yeah, the full screen view is better.
Yeah. Let me
Or did
pull
it
it up.
cut part of it off?
Is that good?
Yeah.
All right. So when you're looking at this, what are you seeing, or what's give people sort of an overview of these couple loan options out there?
As far as like,
What are people doing right now?
yeah, I think people are all about agency loans at this point.
So the middle three right
Middle
now.
three. Yeah.
Yeah.
Paul was saying on the last podcast, or even at the speaker series, that he was talking to the bridge lender at the event, and nobody wanted to talk to the bridge lender anymore. Everybody's talking to agencies now. You know, the bridge lender couldn't get um, was getting swarmed the last couple of years doing a lot of loans, and now it's all about agency loans. So I would say Freddie Mac, SBL on smaller deals, and then Fannie Freddie on some of the larger deals. And
Right.
I was actually thinking maybe on some of the bridge refinancing. What do you think about a Freddie conventional floating to floating? How does that size up?
So yeah, this is I'll try to make this a little bit bigger, but this will make it easier for me to see. Um,
Because you can cut your spread almost in half, and then you can buy a higher cap to where your interest rate is almost the same what you're paying now, but you can buy like a 3 or 4% cap, right?
so this is one of the tricky things on the float is so like down here, um, these spreads are a little bit tighter, so they're
Mm-hmm.
probably 2 to 2.5 right now,
Yeah.
but they're using like so Fannie Mae, they just got into the floating rate business,
Mm-hmm.
and I think they want to be out of the floating rate business already. So, they were losing a lot of business to Freddie Mac
Mm-hmm.
in 2020, 2021 on the floating rate side, and so they're looking at. I'm trying to see if I can find because we did get it quoted. Let me try to show you an example. So let's see if I can find this.
So if you have a bridge loan that's 4%, 4.5% spread, and you're over SOFR and your cap's 2%, so you're paying a 6.5% interest rate. If you refi into Freddie Mac, all of a sudden your spread's 2.5, and then you can buy a 4% cap to where your same interest rate is. So you're 6.5% all in, but then your 4% cap's a lot cheaper than, say you have to buy another cap at 2% coming up. So you're escrowing for that, right?
Yeah, so I
That's
would
kind of my
agree.
thinking.
Yeah, I would agree that if you can do it, then absolutely do it. The debt service coverage tests might like Fannie Mae is they might look at So I showed you that sheet earlier, right? And they were looking at 5.5%, and then they're using that for the debt service coverage test.
Mm-hmm.
Fannie Mae right now is using, so what is SOFR today? Like 4.75, and
Yeah.
then let's say 2% over. So your rate today is 6.75, right? If you did not buy a cap.
Oh, that's what they're underwriting to.
So that's what Fannie's using right now.
So yeah,
And
that's going to be significantly less proceeds. Yeah.
yes.
Okay.
So that's the only challenge that I'm seeing right now. On Freddie Mac, I think so. Before they were able to use like a 1.0 coverage because you were going to buy a cap and all the other stuff, but right now it's a little bit more difficult. So, but I like the idea.
So why don't we just call them up and say just underwrite to a 2.5%, and let's get those proceeds up.
Yeah, I mean that's why like I was on a call, and a lot of people, a lot of the bigger syndicators out there, they're like, I'm floating for life. Like I can't pay the penalty. It's too big of a penalty on these $50-60 million deals. And I agree. You can do that, but you just have to be ready with the money for when those rate caps expire. So as long as you're ready, then it's all good. But yeah,
You need plenty of liquidity at the property level.
yes, plenty of liquidity. So all right, let's hit the next one.
All right, I'll let you tackle this one. When are the rates going down?
I think soon. So I think we're seeing a lot of stuff sort of break in the system. So let's go to the good old surfer curve. All right, let's go to this guy.
It's a dynamic curve.
Yeah, it's moved a lot. So here we go. Here's the surfer curve. So we're sitting at 5% plus or minus right now, and then this thing is like a roller coaster, straight down, and then sort of tapping out at 3. Usually the market, I guess, they're usually higher. Usually it falls like very quickly, and it's usually 5, 4, 3, 2, and then like 0. It just the way it went up was very linear, like 75 basis points a time, 50 basis points at a time, but this thing is like falling down quick. So here's another thing that I look at. This sort of looks at it month by month, I guess you could say. So here's sort of the probabilities on where people are seeing this thing move. Can you see that? Okay, so people they're saying 50%. So I guess it's a jump ball right now on whether they go another 25, but then after that, June, July, September, it's pretty much they see it on a downward trajectory, headed down. So this is going to impact 10-year Treasury. It's going to impact just sort of the shape of the overall curve. So hopefully the inversion comes out. But yeah, this is hopefully. I think we get an inflation reading on Friday, and that's going to tell us. But yeah, I would say rates are going to come down this year. But the hardest thing is just figuring out how to position yourself so that if it doesn't come down or it stays flat for a while, you still got to make your payments. So,
You think it's going to come down? JP was saying it might stay flat for this year.
Are you saying 10-year Treasury or SOFR?
SOFR, Fed funds.
SOFR. The market has it baked in. Market has it baked in, going down from 5 to 3.
Start cutting this year.
That they're going to start cutting. So, but yeah, I mean, I think once we see the pause, then rates are going to come down across the board. So,
what do you think happens at that point? You think everybody starts jumping back in the market?
I think there'll be a lot less volatility. And so once there's less volatility, cap costs will come down. 10-year Treasury won't move around like all over the place, and that'll help stabilize the market a little bit, because we're seeing like like just like you saw when I pulled up the 10-year Treasury, you're like, oh man, we're back up 15 basis points. Like it's moving like 20 basis point increments per day, compared to before it would like move like 3 basis points a day, up or down.
So when the floodgates open back up, are you back to 80% bridge, 10% pref, and then 10% LP?
No, I think I
Wrap
think it goes back to the normal what we talked about, ideal capital stack. I think you just have to condition your LPs to invest at that level.
Yeah, definitely. Looking at the decks and looking at how they're structuring the deals. I mean, some of the deals they're really putting the LP's money at risk. Like if it works out, the GPs are making it big, but any little hiccup, the LP equity just gets wiped.
Yeah.
All
right.
Next question.
Oh yeah. All right, here we go.
Would be great to know what elements affect the interest rate when applying for a loan, and what are some of the standard box checking requirements? So I think NOI is a big one. NOI is a big one that affects the interest. Right now, what affects the interest rate? So yeah, 10-year Treasury affects the interest rate. Prime rate and Fed funds rate is going to dictate. So prime rate is going to dictate your bank loan. So you said it's at 8%, right? So it's plus or minus 50 basis points likely for a bank loan. Treasury is going to dictate the agency loans, and then your bridge loans are floating over the SOFR index, and so the SOFR index is 4.8% today, and so whatever your spread is over the index, and it's likely going to be bridge loans are around 9-10%, and then even I think the spreads on the bridge loan are widening because of the systemic risk of that paper out there right now. So it used to be 3.5% was kind of average. Now it's probably 4.5-5% on the spread plus SOFR. So I'm not really seeing bridge loans be that competitive. And then some of the standard box checking requirements. So we talked about agency you have to have that experience piece. So if you got your Fannie card, or if you're a new investor, you can do a Freddie SBL with a smaller deal. And then some of the loan qualifying boxes that you have to check is like standard net worth has to be equal than or greater to the loan amount. Liquidity has to be 10% of the loan amount throughout the loan duration. So, $10 million loan, $1 million liquid. And these are big hurdles for new people getting into the space, because some of these loans require a lot of net worth and liquidity that somebody just starting out might not have. Trying to think of anything else that checks the box, but yeah, the net worth, liquidity, experience piece are like the big ways that people underwrite these deals. And I always say it's like they underwrite the sponsorship group and then they underwrite the property. There's like the two key elements of getting a loan. So how's your sponsorship group structured? Who's in the deal? And how does that look? And then what does the property look like? How is it producing cash flow? And where is it located? What's the condition of the asset? Anything to add to that?
Yeah, I mean, like I'll pull up the let me see if I can find it. The sort of sheet that we had on financing here. And when you're like, if you can't qualify for these three in the middle, Freddie, SBL, Freddie conventional, Fannie Mae, you're not going to get rates in the 5s and 6s, right? So that's sort of where it starts. So you have to qualify not only as the borrower, but as the property. And then if you're not inside these three columns, then you're going to have to go out to the non-recourse bridge and the bank loan. And that's going to be 7.5 to 10% money, right? So that's really what's going to drive your interest rate, is qualifying for the agency loans out there.
What about hard money?
Hard money?
Any hard money folks out there?
Yeah, hard money. I would say is probably 12 to 15% out there if it doesn't work. So, all right, and I think we had one more question. You want to hit that last one?
All right, last question relates to student housing deals.
Okay.
How easy are those to do?
So student housing is almost like a whole nother
It's like a
bucket.
specialty, right?
Yeah. Um,
It's like going to LITech.
no, it's not that bad. So we had a couple of deals come across our desk that, on student housing, and Fannie and Freddie, they're definitely a little bit more leery of student housing. They're going to look at the university, how far it is from the campus. Can you walk there? Do you have to take a bus? What's your pre-leasing for the next year? Because it's a whole other. We actually did a lot of student housing when I was at GE because Fannie and Freddie don't necessarily love student housing, or it's a little bit trickier to underwrite. And so most guys who are multifamily owners, they can't just step into a student housing deal. Usually, there's a lot more turnover. There's a lot more pre-leasing. So like we're sitting in March of 23 right now. So let me throw out an example to you. We're looking at a deal in sort of central Austin or central Texas. And what do you think, if you're a student housing operator, what do you think your pre-lease for the fall should be right now? Any ideas?
100%.
You want 100%. So all the units are leased because you only have like one more month.
Oh wait, no, you gotta go through if you get accepted there, right? Freshman class is a big deal.
Yeah,
The acceptance letters are out though, right?
Yeah, I mean, I'm just going off of my experience in Austin. Basically, all the good places get pre-leased at 100% already, right?
Yeah.
Super early. So, but on average, you probably should be like 75, 80% leased already right now because you only got one more month, and then people are going to be gone for the summer. Then they're going to come back in the fall, and they want a place to stay. So,
yeah, how does that work? Is there no income in the summer?
So yeah, that's the problem. So if you're a student housing property, you want to sign 12-month leases, right? But then let's say you're 75% pre-leased in the fall, and then you're trying to sign leases in September. Do you think that person is going to sign a 12-month lease? Nope. They're going to sign a 9-month lease. And are they going to pay top dollar? Nope. So we had some properties in Austin when I was at GE where essentially they were like 100% occupied for 9 months. Then it dropped to 50 in the summer. And then probably only 25% of the people were there. So you had 50% of your revenue. And what's the typical expense ratio on an apartment?
I'm going to guess 50% at least.
Yeah. On student housing, I would say it's even higher, right? Because your payroll is higher. There's just a lot more moving pieces on student housing. And so
It's not a C-class tenant.
Well,
you're taking care of.
Well, it's not a C-class tenant, but it's just like a lot of these guys, students nowadays, they want to be pampered. They want the best of everything.
They're paying top dollar to be there.
They're paying top dollar. They want all the amenities. You've got the golf simulator. You got the you got all the food there. You got all this stuff. So your expense ratio is going to be a little bit higher too. So yeah, if you drop to 50% occupancy, you're not going to be able to cover in the summer. And does the bank want to be paid in the summer? I think so.
They hit the pause button.
The mortgage. The mortgage still has to be paid in the summer. So, so student housing is definitely trickier. I would say on average, it's typically lower LTV. So maybe 65% and a 135 cover on debt service on average, and then Fannie and Freddie are going to do it for more experienced operators. So someone this is not their first rodeo. So if it's your first rodeo, you probably need a bank loan. If it's your third or fourth rodeo, then Fannie and Freddie maybe would jump in on it.
Got to be able to handle the swings.
Yeah, it's a lot more swings. So,
Do you find that people that go down that track, are they successful in that track and stay in that track, or are they just get in and get out? Like I'm not dealing with this.
I think you have to be a specialist, and you have to choose a couple universities that cold. Like, like I went to UT, so I had a pretty good understanding of sort of like the pockets that you want to be in, and sort of like what's an A market, what's a B market, what's a C market. So I was gonna try to wrap this up, but I just keep going. So I'll give you a quick example, and then we'll wrap this thing up. And it's hard for you to see unless let me see if I can find it. All right, let's go here. All right, so we'll go down to Austin, right? Have you been to Austin recently?
I don't think I've ever been to Austin.
Okay. So yeah. So all right. We'll need to take you to Austin and show you the sites.
I think there's a train from Dallas to Austin, right?
No train yet. They're working on
I'm
it.
going to Austin in May.
Oh, you are? Okay.
Yeah.
All right. Nice. All right. So here's the campus, right? And let me try to go to the satellite so it's a little bit better. All right. All right. So here's the campus. Pretty much everybody. Is it loading? All right. Maybe my let's see my satellite. All right, my satellite's not working. So West Campus is over here, right? So pretty much all of this west of UT is walking distance to the university. So let's say your rent here is $1,500, right, a month. What would you say your rent if you're all the way over here on Riverside?
1,000.
You're probably $1,000, right? So what happens when, huh?
I'm not living over there.
Yeah.
It's too far away.
I know, but so some people, they only got $1,000. So they're not going to pay the West Campus rents. No. So like a lot of people will pay the West Campus rents and then, or they'll live on Riverside. And now I've got $500 I can spend. I'm going out to the club, whatever. I got the extra $500. And most of the stuff in West Campus was actually old B stuff, like Class B, 1980s. So Riverside was all the new stuff. So a lot of people lived. So we actually did a loan over here on Riverside. And what happened was when West Campus got a lot of new supply, the rents dropped. And then guess what happened to my rents in Riverside? They dropped even more. Plummeted. Right? Because there was so much supply up here that they were trying to lease up and they started giving concessions. And then when my rent's over here, I tried to raise rents. I couldn't do it. So that's why they were on a bridge loan, because they couldn't get normal financing because their occupancy was too low in the summer. So.
All right. We did get one question from one of the viewers. If you want to.
Oh, here we go.
Need to wrap it up.
Right. No. Let's keep going.
Like Dress says, thanks again. Very practical advice. Question on the loan option chart. Will Chase or Wells Fargo give non-recourse multifamily loans? Thanks.
All right. So let's pull up that chart so everyone knows what we're talking about here. All right. Can you see that okay?
Yep.
All right. So Chase is not a Fannie Freddie lender. So they're going to be in this bank loan piece. Mm-hmm. And I would say depending on the market, that's going to drive sort of the terms there. So on the Chase side, Wells Fargo is in this bucket. They can do Freddie, conventional Fannie Mae, and bank loans. So we've done some loans with Wells Fargo, so they can do that. But they have a license on the Freddie and Fannie side with Wells Fargo. So hope that answers your question. All right. We got anything else, or we're going to wrap up right there?
I think that's it. I think we'll wrap up. and then we'll get some more questions. If anybody wants to email us any questions, I guess we have something to put up our emails, or how do they reach out?
Yeah, put it in the comments. I think I'll put up our. Let me see if I can pull it up. This is going to be the thumbnail, I think, or we can make a new one. Let me see. Here we go. I'll put up the thumbnail. Let's see if I can share it. I got too many buttons here. All right, here we go. Boom.
There we go.
There we go. So yeah, you can reach out, just send us an email, and we can jump on there. And I guess thanks for watching. We'll see you next week. All right, I'll see you.
See you.